If you track the world's most specialized technology hedge funds, you expect to see hundreds of independent analysts searching for unique mispricings. Instead, their portfolios are moving in perfect, rigid lockstep. Over the past 18 months, the average technology, media, and telecom hedge fund ran a beta to the S&P 500 of 0.99. For context, from the year 2000 through late 2024, the historical average beta for these exact funds was 0.4. They historically offered less than half the market's volatility, producing distinct, uncorrelated returns. This line chart shows the structural divergence of the equity market itself. The cap-weighted index is rocketing upward, driven by a few massive tech names, while the equal-weighted index flatlines. When the entire index is driven by a handful of mega-cap stocks, a 0.99 beta means these highly specialized funds are effectively functioning as index trackers. Allocators are paying 2% management fees and 20% of profits for Nasdaq exposure they could buy in public markets for 18 basis points. The standard defense from these managers is that they aren't index hugging on purpose. They argue their beta is high because every independent analyst simply arrived at the same conclusion, buying the same few artificial intelligence companies. The data points to a different mechanical reality known as capacity overflow. Look back at the dot-com bubble in the year 2000. During that period, the entire hedge fund universe was small enough that managers could maneuver in and out of mid-cap stocks. They had the agility to express an individual stock-picking edge. Today, individual megafunds manage more capital than the entire industry did 2 decades ago. As assets under management swell past certain thresholds, the mathematics of executing a trade break down. The convergence to the S&P 500 is a mathematical certainty dictated by scale. It is an unavoidable structural constraint. To see exactly how this scale constraint operates, we can examine one of the largest players in the space, Coatue Management. According to their March 2024 SEC filings, Coatue reported $59 billion in discretionary assets under management. This diagram shows the basic math of portfolio construction. If a portfolio manager at Coatue wants to build a standard, conviction-weighted position of 2.5% across a $59 billion fund, the math requires an allocation of nearly $1.5 billion for a single stock. This creates a severe liquidity constraint. Trying to deploy $1.5 billion into a smaller, mid-cap technology company without moving the stock price against yourself is impossible. As we filter the U.S. equities market by the liquidity required for a trade that size, the investable universe drastically shrinks. The list isolates down to a handful of companies with market capitalizations well above $100 billion, the Magnificent Seven. By forcing the majority of the long book into the same massive names that dominate the Nasdaq 100, the manager eliminates the exact diversification surface they need to outmaneuver the benchmark. At $59 billion, a firm cannot express a unique analytical edge in mid-cap stocks at a scale that actually impacts the overall portfolio. They are trapped in the megacaps. We can track how this theoretical math translates into actual investor outcomes by looking at Coatue's 2024 performance. The firm reported a headline gross return of 18.7% in its main long-short fund for the year. This data table places that 18.7% gross return next to the underlying Nasdaq 100, which returned 25.88% over the same period. If we adjust for a conservative 0.87 Nasdaq beta, the beta expectation for the fund sits at 22.5%. Comparing the actual return against the beta expectation reveals a gross alpha of negative 3.8 percentage points. The fund underperformed the baseline factor exposure. That is, before accounting for the standard fee structure. Investors pay a 2% management fee on total assets and 20% on the profits, which strips away nearly 6 percentage points of the total return in a positive year. After subtracting the fee load, the net alpha delivered to the investor is approximately negative 9.5 percentage points. Institutional allocators are paying tens of millions of dollars in fees for a vehicle that delivers almost 1,000 basis points less than a low-cost systematic index fund. Coatue is a symptom of a broader category decay. We can map the decline of the entire technology hedge fund sector by looking at the historical data. Between 2010 and 2019, specialized funds operated in an environment where capacity constraints did not yet bind the whole industry. This line chart tracks the gross alpha of the tech hedge fund category. Over that 10-year window, a universe of 85 tracked managers overseeing $45 billion in total assets generated 7.1 percentage points of annualized alpha. Compare that to today. Coatue alone manages $59 billion, eclipsing the entire tracked category size from that previous decade. As total capital ballooned, the trailing 18-month category alpha dropped to 4.2 percentage points. The alpha decay curve demonstrates that the systemic edge is not disappearing because managers lost their skill. It is suffocating under the sheer mass of excessive capital. To mitigate this concentration risk, institutional allocators typically hire multiple managers across different asset classes, building complex portfolios to diversify away the mega-cap tech exposure. At the individual level, this seems to work. PivotalPath data shows that the average single credit manager maintains a moderate 0.47 correlation to the broader equity market. Standard portfolio theory assumes that combining dozens of these moderate correlation managers will isolate their specific alpha and keep the total portfolio's correlation safely constrained. This correlation matrix visualizes that assumption. Each cell represents a manager with a safe 0.47 correlation. But when allocators aggregate these managers into a single index, the reality shifts. Because a moderate artificial intelligence factor is embedded in almost every single manager's logbook, aggregating the portfolios compounds the AI exposure. The aggregate credit index runs a 0.94 correlation to the S&P 500. Attempting to diversify across scale-constrained managers fails. It simply rebuilds the benchmark index at the portfolio level while stacking a massive layer of aggregate fees on top of it. This thesis relies on strict conditions. The structural capacity trap remains valid unless market breadth recovers and the equal-weighted index closes the gap, or if the technology hedge fund beta prints durably below 0.6. But there is an unverified variable hiding in the dataset, the AUM band decomposition. The 4.2% residual category alpha that still exists is not distributed evenly. The data indicates this alpha is almost entirely carried by nimble, sub-$2 billion managers. These smaller managers operate below the $1.5 billion position sizing threshold. They can take concentrated positions in mid-cap stocks and realize actual alpha without facing the liquidity constraints of the megafunds. This creates a paradox for institutional allocators. They need the returns of the smaller managers, but their minimum check sizes are so large that allocating to a sub-$2 billion fund would instantly overwhelm the manager's capacity. At institutional scale, the hedge fund alpha engine is broken. Not by a lack of talent, but by the gravitational pull of its own mass.